Ever wondered what a halal mortgage is? Well, let's unravel this mystery together. A halal mortgage is a unique financial tool designed in accordance with Islamic principles, which strictly prohibit the use of interest. Quite a departure from the traditional mortgages we're used to, isn't it? So, how does it work, you may ask? Instead of charging interest, halal mortgages operate on a profit-sharing model. This means that the lender and borrower enter into a partnership, where both share the potential profit as well as the risk of loss. In essence, the lender purchases a property and then sells it to the borrower at a higher price. The borrower then repays this amount over a predetermined period. It's a fascinating blend of ethics and economics, wouldn't you agree? Halal mortgages are a unique way of financing a home, but how did they come about in Canada? Stay tuned as we delve deeper into the history and intricacies of halal mortgages in the next segment. The journey of halal mortgages in Canada is an interesting one. Islamic home financing was introduced in Canada a few decades ago, but it has gained significant recognition only in recent years. This unique interest-free financing model was created to align with Islamic principles that prohibit the charging or paying of interest, a concept known as riba. The Canadian government, acknowledging the diversity of its citizens and their unique needs, has made strides to make these halal mortgages more accessible. This initiative is a part of the government's commitment to support diverse communities and help them enter the housing market. As a result, more people, regardless of their religion, are now able to secure a home without compromising their religious beliefs. Halal mortgages in Canada are not limited to specific provinces. They are accessible across the country, ensuring that anyone who meets the necessary credit and income criteria can apply. Typically, potential homeowners are required to provide a 20% down payment to secure a halal mortgage. Over the years, halal mortgages have evolved, and currently there are 3 types available in Canada: Ijara, Murabaha, and Musharaka. Each type operates on a profit-sharing model, which eliminates the need for interest. Despite the costliness associated with halal mortgages due to limited access to low-cost capital, many people are opting for this ethical and long-term fixed-rate option. The rise in popularity of halal mortgages in Canada is a testament to the country's commitment to inclusivity and financial fairness. At the heart of it all, the purpose of halal mortgages is to ensure that everyone has access to home financing options that align with their personal beliefs and values. The result is a more inclusive and diverse housing market where everyone feels welcome and accommodated. So, halal mortgages have been around for a while, but how exactly do they work? There are 3 types of halal mortgages in Canada: Ijara, Murabaha, and Musharaka. Let's start with Ijara. This is essentially a leasing arrangement. In this model, the financial institution buys the property and then leases it back to the homebuyer. The homebuyer makes payments over a fixed period, and at the end of the term, the property is transferred to them. It's a bit like rent-to-own, with the advantage of not dealing with interest rates. Next up, we have Murabaha. This is a cost-plus financing model. Here, the financial institution purchases the property and sells it to the homebuyer at a fixed profit margin. The homebuyer then repays the cost in installments over a specified period. This model provides transparency in terms of costs, as the profit margin is agreed upon at the outset. Lastly, we have Musharaka, which translates to partnership. In this declining partnership model, the homebuyer and the financial institution jointly purchase the property. The homebuyer gradually buys out the financial institution's share over time, hence the term declining partnership. This model fosters a sense of shared risk and reward, aligning with the principles of Islamic finance. So, how does one go about acquiring a halal mortgage? It's not much different from the conventional process. You'll need to apply with a financial institution offering halal mortgages, meet the credit and income criteria, and typically make a down payment of around 20%. Remember, halal mortgages aren't exclusive to Muslims. Anyone can apply. Now that we know how halal mortgages work, what are their pros and cons? Like any financial product, halal mortgages come with their own set of advantages and drawbacks. Let's start with the benefits. For one, these mortgages are ethically sound. They align with Islamic principles, eliminating interest and instead operating on a profit-sharing model. If you're someone who values ethical financial practices, this might be a compelling reason to choose a halal mortgage. Furthermore, halal mortgages offer long-term fixed rates. This provides a measure of predictability and stability. You won't have to worry about fluctuating interest rates and can plan your finances with more certainty. On the flip side, there are some drawbacks to consider. Given the unique structure of these mortgages, they can sometimes be costlier. This is primarily due to limited access to low-cost capital, which can make these mortgages more expensive than their conventional counterparts. In conclusion, halal mortgages offer a unique, ethical way of financing a home, but it's important to consider all factors before deciding if it's right for you.